Hi, this video is an overview of how our U.S. federal income taxes are calculated. Now, the first thing I want to tell you is I'm not a tax professional. I'm a math instructor at Portland Community College, and so this does not constitute tax advice. This is just so we can learn how taxes work. And even though you might file your taxes using an online system, it's really good and important to understand how they work and what's going on. What are ways you can impact the taxes you pay? Okay, so let's go through. This video will be a general overview of the process. In another video, we'll do an example to make it more concrete. But for right now, I'm just going to go over all of the steps. Okay, this is for tax year 2018, or you might be seeing this in a future tax year. If so, then this part all works the same. It's just that some things were eliminated from the 2017 to 2018, so this is a new video. Okay, when calculating your income taxes, we always start with your gross income. So this is your total income. It could be from one source or more sources. So this would be any wages, salary, tips, interest, and also things like child support or alimony, any kind of income that you have. Okay, total that all up, and that's your gross income. But we don't pay taxes on that. First of all, there are some adjustments. These above the line adjustments are things that are taken out pre-tax. For example, if you have any retirement savings like a 401k or IRA, or if you pay for benefits, part of your benefits through your employer, those are all done pre-tax. So all of those things get subtracted out. So that would be, these are like pre-tax things like IRAs, 401k, benefits. Anything like that is deducted out in advance is called an above the line deduction. So once you subtract that out, that's called your adjusted gross income. Adjusted gross income, or AGI for short. You might hear that a lot, AGI, AGI, adjusted gross income. Okay, so once you have your adjusted gross income, then you still don't pay taxes on that. You get to take what's called a standard deduction, or if you have itemized deductions, you get to take the higher of these two, different color, the higher of the standard deduction or the itemized deductions. Okay, so the standard deduction we find from a table, and I'll show you, we'll be using this table. You'll be using this table in calculations. Here's the standard deduction in 2018. Married filing jointly, $24,000. Single, $12,000. Head of households, which means you are claiming children or other dependents, $18,000. Married filing separately, $12,000. Okay, so you would subtract either your standard deduction or itemized deductions. So what are some things you can itemize? A really big benefit of home ownership is deducting your mortgage interest. So deductions are things like mortgage interest, donations you can also deduct. There's a lot of deductions. These are some of the major ones. Also, if you have medical expenses that are above a certain amount, or work expenses above a certain amount, usually above a certain percentage of your income, then you can deduct those. So maybe medical or work expenses. Okay, this is where I'm not a tax professional, but when you use the online software, it guides you through all of the different possible deductions you could get. Okay, the idea is to itemize as much as you can, so you get this number as large as you can. And then you want to take the higher of the two, either the standard deduction or your itemized deductions. Okay, and we will do an example of this in another video. Once you subtract all that, that is called your taxable income. Okay, so taxable income is what you go to, it's that number that you use to calculate your taxes with the tables. Okay, so after you get that number, you'll be using these tables, these actual tax tables. So for example, someone who's filing single, we would, and I'll show you how to do this in the example, go to this table and calculate their taxes, and that is their taxes due. Okay, so that's the tax amount from the tables. Now there's one more thing that can help you out with taxes, and that's called a tax credit. Okay, tax credits are great because they reduce your tax amount directly, like dollar for dollar. Up here, when you have these deductions, that's before you use a percentage to calculate your taxes. So anything you can take off up here will save you a percentage amount of your taxes. But this will save you dollar for dollar. This directly subtracts from your tax amount any tax credit. So things you might get tax credits for, there's a child tax credit. There's also an earned income tax credit. And the thing that's great about these also is they are directly refundable. So if you actually have more credits than tax you owe, you could get money back. Of course, you have to file. That's the important thing. You have to file to get that money back. So these are fully or partially refundable. Fully or partially refundable. So that is also really helpful. Okay, so once you subtract that, you find the tax amount that you owe using the table. You subtract off any credits from that if you have them. That is your taxes due. So that's the amount that you are actually paying for that year in taxes. Okay, now if you've been getting a paycheck, you've had withholdings from your paycheck every week or 2 weeks or month, whatever it is. So that's called the withholdings, which is from your paycheck. If you had withholdings through the whole year from your paycheck, if they withheld less than the taxes due, then that means they didn't withhold enough. That means you're going to owe money. So you're going to owe the difference. Okay. Usually people aren't very happy when that happens. Taxes are very important because they pay for all the services we need. They even subsidize education at PCC. However, I understand nobody likes to pay taxes. Now, if your withholdings are more than your taxes due, so all that money that's been taken out, if that is more than what you owe, that's when you get a refund. And of course, there's some other things involved in here, like how much you can set how much is withheld throughout the year to try to make it come out as even as possible. Okay, so that's an overview, and we'll do an example in the next video.